All right, let's dive right into this explainer and follow our avatar, John. Now, if you've ever had money just kind of sitting around in a savings account and thought to yourself, I should probably be doing something with this, then this is exactly for you. We are going to look at how John takes a single one-time savings of $5,000 and turns it into a massive nest egg. We're talking over $250,000 here. And he does it simply by tuning out the noise, keeping his fees low, and trusting the absolute magic of compounding over time.
Here's a quick look at our agenda for today. First, we'll cover what ETFs actually are. Second, the 3 filters for choosing them. Third, building that starter portfolio. Fourth, how to buy them. Fifth, the real secret to holding. And finally, we'll look at an aggressive growth option.
Okay, Section 1. What are ETFs? Let's demystify some of this jargon. You know the financial industry absolutely loves to make things sound way more complicated than they actually are. But the crucial takeaway here is that an ETF, which stands for Exchange Traded Fund, is literally just a basket. That's it. Instead of buying ownership in one single company, like say buying Apple stock and just crossing your fingers that they have a good year, an ETF lets you own hundreds or even thousands of companies all at once. It's one single purchase that gives you instant diversification. If one company in your basket has a terrible year, well, the hundreds of others are there to carry the weight. You don't have to stress about picking the winners because you're just buying the whole market.
So you might be wondering, well, how is this any different from a mutual fund? And this brilliantly illustrates what I like to call the Goldilocks solution. A mutual fund is also a basket, sure, but someone is actively managing it, and they want to be paid a lot of money for that guesswork. Actively managed mutual funds typically charge you anywhere between 0.5% to 1.5% every single year, and they charge that whether they make you money or lose you money. Over a 30-year span, that fee is absolutely devastating to your wealth. ETFs, on the other hand, give you the exact same diversification of a mutual fund, but without that expensive manager eating up your long-term profits. They just passively track an index. Because there's no highly paid manager pulling the strings, the fees completely plummet to between 0.03 and 0.3%. It's a game changer.
Moving on to Section 2, 3 filters. How do we select the right ETF? To filter out the thousands of really bad options out there, John uses a super simple rule of 3. Filter number 1, the expense ratio has absolutely got to be under 0.2%. Why? Because over 30 years, fees are literally the most expensive thing in John's financial life. Think about it. A fund charging 1% a year is essentially skimming $10 out of every $1,000 John has year after year after year. By strictly capping his expense ratio at under 0.2%, John guarantees that his money is actually staying in his own account to compound, rather than paying for some Wall Street firm's shiny new marble lobby. And spoiler alert, every fund we're about to look at easily passes this test.
But beyond just ultra-low fees, John relies on 2 more filters. Filter number 2, he ensures he knows exactly what the fund tracks. Listen, the marketing name of a fund means nothing. You have to look under the hood at the actual index. Does it hold 500 companies or 8,000? Is it all tech or is it a global mix? Knowing exactly what's inside is what keeps you from panicking when the market inevitably drops. And filter number 3, it must have a proven track record. John doesn't care at all about how a fund did last year. He wants to know, did this fund survive the dot-com crash, the 2008 financial crisis, the 2020 pandemic? Surviving those brutal cycles proves the fund is truly tested and trusted.
All right, Section 3, building the starter portfolio. Let's allocate John's $5,000.
Let's see exactly how John splits his money across 3 specific funds, because each one has a very distinct job. He divides his $5,000 with serious intention. Half of it, so $2,500, goes straight into VOO for U.S. market stability. VOO tracks the S&P 500, the 500 largest American companies. Think of this as the floor of his portfolio. Next, 30%, or $1,500, goes to QQQ for tech-driven acceleration. QQQ tracks the NASDAQ 100, which is heavily concentrated in massive innovators and tech giants like Apple, NVIDIA, and Microsoft. If VOO is the floor, QQQ is what pushes the ceiling higher. Finally, the last 20%, that's $1,000, goes into VXUS for global balance. This fund tracks over 8,000 companies outside the U.S., giving John that crucial geographic diversification. 3 funds, 3 vital jobs.
Now, by combining a 13.64% blended appreciation with automatic dividend reinvestment, we get to see the real magic. This beautifully visualizes how his one-time $5,000 investment compounds into nearly $270,000 over 3 decades, and he doesn't add another dime. Look closely at how compounding builds momentum. At year 10, he's at roughly $19,500. Not bad, right? But by year 20, the snowball is really picking up speed, hitting over $73,000. And by year 30, that exact same $5,000 has exploded into $268,954. The capital appreciation is definitely doing the heavy lifting here, but those automatic dividend reinvestments add over $6,000 completely in the background while he sleeps.
Section 4. How to buy ETFs. It's time to turn that cash into real assets.
A lot of financial advice completely stops at the theory stage, but let's walk through the actual mechanical steps. In under 15 minutes, John takes 3 simple actions. Step 1. He opens a free account with a major broker. Think Fidelity, Schwab, or Vanguard. There are no account minimums and no monthly fees. Step 2. He funds the account by transferring his $5,000 straight from his bank. And step 3, this is the most vital part, he simply searches the tickers VOO, QQQ, VXUS, and executes the buy order for those designated dollar amounts. Oh, and he absolutely makes sure to check one specific box in his account settings: turn on automatic dividend reinvestment. That right there is the engine for free compounding.
Now, if you're watching this explainer and thinking, well, that's great, but I definitely don't have $5,000 to drop right now, please don't worry. Fractional shares mean your minimum contribution is simply whatever you can afford today. This is a total game changer. You don't need to cover the exact full share price to buy into these massive funds anymore. If VOO is trading higher than the actual cash you have on hand, it doesn't matter. You can put in $50, $100, whatever you've got. The brokerage just buys you the exact fraction of a share that your amount covers. The only true minimum is what you have available right now.
Section 5. The secret to holding. Let's talk about the psychology of investing.
Okay, so the portfolio is built, the money is invested, which brings us to the absolute most difficult psychological hurdle in this whole process. Every single instinct is going to scream at John to check the financial news, react to market drops, or maybe move his money around when one fund is temporarily outperforming the others. So what is his actual next move? What does he do to protect his future wealth?
The correct answer is absolutely nothing. Seriously, because reacting to market volatility is the absolute quickest way to destroy your wealth. He doesn't check the portfolio every morning with his coffee. He just lets the portfolio do exactly what it was meticulously built to do, and he gets out of his own way.
John fully anticipates that the market is going to drop significantly at some point. Actually, scratch that. It is a guarantee that markets will experience 20% or even 30% downturns over a 30-year timeline. But he holds strong, because the investors who lose money permanently are the ones who sell out during a panic and then never get back in. John lets those dividends auto-reinvest, and he only checks his account once a year. And when he does check it, he's really just seeing if the balance has shifted. Say QQQ had a massive run and is now 45% of his portfolio instead of the planned 30%. He just sells a little bit of it, buys a little of the others, and resets it to the original plan. Then, he closes the app for another 12 whole months.
Finally, Section 6, the aggressive growth option. Let's look at maximizing those 30-year returns. For those of you with a genuine 30-year timeline who can stomach a bit more of a roller coaster, let's explore a bonus strategy that really turbocharges these numbers. By dropping the global VXUS fund, introducing a hyper-concentrated tech fund called VGT, and adjusting his core allocations, John creates a much more aggressive growth engine. Look at the shift here. VOO drops down to 40% to make some room. QQQ steps up to 35% for even more NASDAQ concentration. And instead of international safety, John puts 25% into VGT, that's the Vanguard Information Technology ETF, tracking over 300 US tech companies. VGT's one and only job is maximum long-term growth, but the major trade-off here is that it will drop harder than anything else when tech inevitably has a bad year.
But if John can stomach that wild ride, by simply shifting his risk tolerance and utilizing VGT, that exact same $5,000 starting amount projects out to a staggering $640,414 at year 30. No way, right? But it's true. That is a difference of over $371,000 compared to the starter portfolio, driven entirely by a higher blended average annual appreciation of 17.35%. It's the exact same timeline and the exact same one-time investment. The only variable he changed was his risk factor.
So the math is crystal clear, and these tools are readily available to you for almost zero cost. The only question left to ask yourself is how much risk are you willing to stomach, and when are you going to take that first step to build your own financial blueprint? Are you going to keep letting your hard-earned money sit idle, or are you finally ready to let the incredibly powerful engine of compounding start working for you? Think about it.
Thanks so much for joining me on this explainer, and I will see you next time.